Welcome back, everybody. Today we are looking at the top 5 stocks to buy in the stock market right now. And without further ado, let's get into it. So the first stock that we're doing is Google. I think Google is an amazing company, and right now you could buy it at a 20 forward PE ratio, which is right in line with the S&P 500. But I think it deserves a higher multiple than that because of the wide moat that they have. If you think about it, you don't tell somebody to search something, you tell them to Google it. And then the most searched thing in Bing is Google. That's how like people love that search engine of Google. And then not to mention stuff like YouTube and Google's cloud business and Android. It's just an amazing company. And as you can see, they are about essentially flat in the last year, but they've had these big swings. I think they're down, year to date, 22%. This is an amazing time to pick up this company, and let me highlight some of the reasons why more so. So as you can see, their top line revenue growth is consistent. A lot of companies right now are struggling to grow their top line at any meaningful level, but Google was able to go from 55 billion last year to 68 billion just in this quarter end, which is amazing. And then that resulted in operating income from last year 16 billion all the way up to 20 billion. And then Google's already said that they're going to buy back $70 billion of stock. It's just an amazing company. And that's not even half of it. So Google's balance sheet is the best balance sheet in the entire world. So right now they have about 135 billion in cash and cash equivalents, but their total liabilities is 103 billion. So they could take all their cash, pay off all their liabilities, debt, all that, and still have cash left over. I don't know if any company in the world besides Google can do that. They are not going anywhere. I feel like this is a no-brainer. And analysts agree. Right now they have the average price target of $3,168, and right now it's at 2,200. So you have a lot of upside according to analysts. Yeah. And then they have a rating of it as a strong buy right now. So the next stock is Disney. Disney right now is getting absolutely killed. They are down 38% in the last year. They have a forward PE of 26, which is above the S&P 500, but I definitely think it deserves it. Again, it's a world-class company. If you gave someone, $100 billion to replicate what Disney has, they couldn't do it with Star Wars and Marvel. The fan dedication to those medias, you'll never get that again or replace that, I don't feel like. And then a couple highlights from Disney that I think makes it a buy. So they're continuing to grow Disney Plus. This is the main way they've already reiterated they want to get content out to the viewers and hopefully monetize that in a profitable way. Because right now Disney Plus is not profitable. So I feel like investors are really punishing them for that. But as you can see, the Disney Plus grew from 103 million last year to 137 million this year, which is insane growth. They've already projected that they want to have 250 million by 2024, and I definitely think they can get that. And another bull case for Disney is their parks. Their parks are these cash cows, and they're already more profitable and generating more revenue than they were pre-pandemic, which is amazing to me. In 3 months ended, they Parks and Parks Experiences, which is obviously the parks, generated 1.7 billion dollars in just 3 months, which is amazing to me. So I would definitely add Disney to the watch list. Right now it's getting absolutely killed, but I feel like it's a good time to accumulate some shares. Limited downside, huge upside, I feel like, for this, if they can get Disney Plus profitable and bolster that bottom line. So the next stock we have is TRow. Again, this stock is getting absolutely killed in the last year, down 36%. This one's heavily tied to the market because they're an asset manager. They hold many stocks, ETFs, and all that. So as the stock market goes down, their assets under management, which they collect a fee on, will go down. So the revenue will go down, which will affect the earnings per share. So this one's really volatile with the market, but I feel like you're getting super cheap stock with a dividend that is nearly 4%, and growing. So they pay these. So as you can see, it's continuing to go up. Just a year ago, they paid 76 cents. Now they pay $1.20 a share, which is amazing. But TRow price, since they're an amazing business, and I feel like they have absolutely no debt, so they constantly stockpile cash. And then when they feel like they get too much cash, they issue these special dividends. So as you can see, they had this special dividend of $2 back in 2015, and just recently they had a $3 special dividend. So I feel like even with the market volatility, they have no debt, so they don't have anything to worry about. Just they keep stockpiling cash, and then when they feel like they have enough, they return that back to the shareholder. It's an amazing business model. And then, as you can see, their revenue is increasing year over year constantly. Even in this market downturn, they're still up 2% in the last quarter compared to the previous year. And then the earnings per share follows. It's just nice consistency. You're getting a 4% dividend yield right now. I don't think you can beat this dividend. Aristocrat, even I think, has been paying its dividend for 35 years. It's just honestly a no-brainer to me. And they're trading down because of the market volatility, but it's a definitely good time to accumulate some shares and just buy TRow. And the next stock we have is Apple. This one is kind of a no-brainer. Apple, a lot of people think it's top 3 company in the world, and it's the biggest stock that you can buy. It's at a 2.36 trillion market cap, which is insane to think about. But even with that, they have a 24 forward PE ratio, which is above the S&P 500. But if you think about what you're buying with Apple, it's amazing. The moat that they have. No one's ever thinking about switching from Apple to Android. Once they have you in their ecosystem, they're going to continue to do that. They're lifetime customers. I mean, I know I am. I'm not looking for the next Android to buy. I'm looking for the next iPhone to buy. And then AirPods, all that. And then they're also research and development into a new car and Apple TV. They're coming out with a new one of those. It's an amazing business. And that can be seen in their top line growth. So even though it is not as drastic, I would say, as Google, they are still increasing their total sales. And then their big the growth driver is their subscriptions, and I'm trying to find it. I'm not sure where it went. Sorry about that. But their services revenue is another. They have insane margins on their services, and that's continuing to grow year over year. That includes like Apple Music, Apple TV, and we love to see the top line growth. And then they're buying back billions upon billions of dollars worth of shares, and that's bolstering up their EPS, which shareholders love. And as you can see, there's shares outstanding. Yeah, like they're just an absolute cannibal. Every dollar that they have, they're buying back their own shares because they still feel like they're cheap. And even in the last year, they bought 3% of the shares outstanding, which is amazing to me. And then the last stock that we have today is Costco. Costco right now had a huge down day on the backs of Target and Walmart. Really disappointing in their earnings, but ignoring that, their forward PE, I don't think this is accurate. I think it's closer to 30 with this huge drawdown. But still, Costco is one of those companies you just buy and hold for the rest of your life. Their earnings are as consistent as it can be. And this is the revenue here, just as consistent as can be. Never in the last 10 years having a quarter that was lower than the previous quarter. It's amazing. And then the earnings per share continuing to go up. It's insane. And they have had a few negative quarters, but still, as you can see, just insane growth on their EPS. Right? You are paying quite the premium, right? A 30 PE is almost double the S&P 500 average, but for the reliability of Costco's earnings and revenue, I'm willing to pay up that premium. And then Costco also does these special dividends. Their last special dividend was $10. But on a quarterly basis, they pay about 90 cents. So as you can see, these special dividends that they have are absolutely huge. Because again, they have little debt, so they accumulate cash, and then when they feel like they have too much cash, they return that to the shareholder. I think Costco, if you have to have a 5-year time horizon at least with this one I could see pulling down a little bit more because from a PE perspective, it is very expensive, but I still think it's an amazing company. They pay a reliable dividend, and I'm expecting a special dividend within the next like 12 months, 2 years. So if you guys like this content, I hope you like and subscribe, and I hope to do more of these videos. I had fun, and I'll catch you in the next one. Peace.